Listen, welcome along to today's presentation, what asset segregation means to a self-managed superannuation fund. Now, this is an interesting sort of conversation piece for me because there's a lot of stuff to talk about there. And what I really want to, I guess, engage in today and talk about with you is primarily about segregation from an administrative point of view, so from a trustee point of view. So whilst I will delve into and touch on the ECPI rules, because they are a very valuable part of the entirety in relation to asset segregation, I'm not going to go in depth into how all the calculations are performed. I'll leave that up to the actuaries because they are certainly the master of that area. So really what I'm looking at identifying here is all the issues associated with asset segregation from an SMSF point of view. Stock down disclaimer. Of course, I highlight within the presentation that we are expecting some potential changes with reference to segregation, particularly around some of the ECPI and actuarial certification requirements from 1 July. You know, we're slowly running out of time to see a lot of the legislation and things to come in. So it will be interesting to see where we get to with reference to that moving forward, given there were a number of other measures we're still waiting on in the superannuation space. So as always, if you've got any questions, please shoot them through. I've already had a question or a scenario sent through to me. Thank you to Anthony in reference to that. And it's a really terrific situation, or maybe not so much for the clients, for us to discuss potentially as part of today's presentation. So I'll work out where the best point in time to bring that scenario into the equation will be. So what are we going to get to today? Well, what I want to really touch on is how segregation can be defined as a tax strategy or an investment strategy or both. So whilst largely the concept of what we're talking about is tax driven, and most of the presentation, certainly from the number of slides point of view, is really focused on that concept of tax segregation. The ongoing concepts that I want to discuss really do apply all the way through, and I certainly hope that despite the slides or the lack of therefore with regards to investment strategies, doesn't detract away from the fact that segregation is largely about multiple areas. Disregarded small fund assets is an area that confuses a lot of people within the industry. And look, I think segregation overall is an area that confuses a lot of people within the industry, but I'll touch on disregarded small fund assets and highlight the issues already that I see with them with reference to the super funds. And of course, the risk and rewards of segregating assets. So what are our pros and cons linked with all that? So look, let's kick into things and work through for the next hour issues associated with segregation. So firstly, how does the law define asset segregation? Pretty simply, Section 295(385) of the Income Tax Assessment Act, and you know, without regurgitating the entirety of the legislation, it identifies that we're talking about exempt current pension income. And so what it references is that any income from assets that are invested for the sole purpose of enabling a fund to discharge its pension liabilities, then those assets are effectively segregated pension assets. Now, there's other areas that the legislation delves into, but clearly what we're talking about from a pure taxation and super law point of view, that is exclusively the segregation definition that we have to deal with or we have on offer. So ultimately, it talks about assets put aside solely for the purpose of paying a retirement benefit. It also goes into the point that segregated assets cannot exceed the value of the member's account balance. And look, that's actually you know, one of the first points that becomes relevant in this conversation piece that Anthony and I were having. And so we'll touch on that, as I said, a little bit later, but becomes a relevant key point in that we can't have assets greater than what our members' account balance is. And it is specific to retirement phase income streams. So ultimately, as far as we're all concerned, and as far as we can all consider segregation from a pure legislative and definition point of view, it's all about retirement income. So that's how the law defines it for us. How does everyone else define asset segregation? Well, quite frankly, they do it pretty loosely. I think it's one of those areas, having been in the SMSF space now for long enough. I think that's the best way to define it. I've been in the industry long enough. Segregation is probably one of those areas that has troubled the industry from the get-go. We've had numerous legislative attempts at changing rules around actuarial certificates and the timing of actuarial certificates, how long they last for, whether they should be abolished. Obviously now we've got disregarded small fund assets that we'll touch on a little bit later in the presentation. And then we've got member investment choice and where that sits within the governing rules of the fund, within the SIS legislation and those other sorts of areas. So segregation is this very loose term that is thrown around and often misunderstood and misrepresented in the way that funds operate. But asset segregation can be at a fund level. So at a fund level would be where we're primarily identifying pension assets under the tax law from accumulation assets to determine what the appropriate deduction is. It can be at a member level, and again, a member level is not too dissimilar to the fund level if you've got a pension member and an accumulation member, but then we can break that down and it can actually have it where one member might have certain assets associated with them and linked specifically to them for their pension account, but then their accumulation interests are in a more pooled and generic under a pooled and generic fund investment strategy. So, even member level, it all can be broken down specifically or more broadly. It can apply to single assets. So again, we can talk about segregating assets or partial segregation. And this is where, again, complexities, and I'll re-raise a number of these points throughout the presentation. But when we start to talk about fund level segregation, pretty simple. Administratively, it's pretty simple to determine that. And most of the systems out there can deal with fund level segregation. Member level segregation, some of the systems will deal with that as well. I'm talking about the accounting systems and softwares, but they will start to struggle a little bit more in that space. You're effectively starting to prepare almost multiple sets of financial accounts. And then once we start to get to single assets and asset segregation, then again, we would definitely have complexities associated with that, particularly if that asset is a single asset segregated across, say, multiple members or a single member, but not aligned up with other benefits that that member has. So the asset might actually be larger than their accumulation account, so it goes across their pension and accumulation. So all these sorts of things are legislatively possible, they're just administratively problematic. So it can be a tax strategy, and of course, from a tax strategy point of view, that is largely what drives the conversation piece around today. So it can also be, as a final point, an investment strategy. So, particularly we saw the introduction into the center of the conversation piece around six-member superannuation fund. Again, it's a measure that we will, whether we see the introduction, there is cross-bench support on it, whether we see that introduction sooner rather than later. It's going to be a timing issue. We're heading into budget territory. So, where do all of the or the measures that haven't been passed, where do they all sit, and when will we see them potentially come into force, knowing that, say, six-member funds comes into force the quarter following its royal assent. So, potentially now we're in an environment where it won't be coming into play until 1 July 2021 at the very earliest, considering that it's unlikely that we're going to see anything now, given the sitting days have passed for the Senate until May. We're not going to see anything for a 1 April start date. So, investment strategies and how they work from a member investment point of view is fairly important. So asset segregation is, for me, a nightmare on admin street. It is an area where we've got just such complexity associated with how the funds have to operate. Trustees need to have a greater understanding of what segregation means. And I thought nothing better than, one of the scariest all-time movies from the 80s to represent asset segregation from an SMSF space. So, from an administrative point of view, trying to get funds and trying to get people to understand segregation has always been complex. And it's also been made a lot more difficult in many respects for the reasons that a number of for want of a better term, old school SMSF administration platforms, talking about the more, not necessarily corporatized, but those where you had associations linked with fund managers or whatever, where they often operated on a segregated approach just under their natural process, where you had mum and dad self-managed superannuation funds and the investment portfolios were kept strictly separate from a bank account point of view to all of the investments. Those sorts of self-managed super funds exist, and they create a mindset for the trustees of those funds where they've always operated in a segregated environment. And then if they move out of those platforms into a standard broking account, share sponsorship, whatever else, and move all of those assets across, they often don't understand that segregation was in part forced upon them in that administrative space, and arguably wasn't necessarily a bad thing, but then they have to understand that they don't necessarily need it. So when we talk about segregation, we touch on it being actually a part of the SMSF life cycle. And whilst most of us contemplate it purely from that retirement point of view, once we generate income in the fund, it's actually applicable right from establishment. And one of the admin messages that I would get across in reference to this space is that the earlier a fund adopts segregation, then the easier it is to administer. And I make the point a couple of times that it is a prospective tax strategy. So it's not something that you try to apply after the event to go back and segregate the assets. And when we start to talk a little bit about disregarded small fund assets and the way forward with reference to retirement phase income streams, we are having to, in effect, plan in advance from the first year, but we have to look back to total superannuation balance and other matters to determine where we're sitting. And so the eye on segregation really doesn't, it's difficult to say when the new law comes in, but it's going to be one of those things that you're going to have to be addressing early in the year, albeit that the capacity to segregate won't be known in some instances until the total super balance is determined, which will be later in the year. So it's a prospective strategy that may be implemented administratively after a point in time. And that is going to create complexities that we have to get our head around as administrators, as accountants, certainly from an audit point of view, and also most definitely then from a trustee point of view, understanding how things fit. So it's ever present. It's one of those areas that we would need to be addressing from the very start of the fund, particularly as we bring generational change in and potentially other members into the super environment. So why are we segregating? What are we really identifying the purpose of why a fund is trying to segregate? Well, it can be useful, obviously, for funds with members in different life stages, as I've just identified on the previous slide, because they'll often have different objectives and certainly different income needs. And that marries itself in nicely with having different investment risk profiles. And I think the investment risk profile is one of the key issues that we need to be mindful of. And whether we talk positively or negatively about increasing the size of self-managed superannuation funds, let's say it is legislated we move up to 6 funds. Well, history will show us that not a lot of funds move beyond 2 members, but maybe that's because there is this barrage of larger families waiting for self-managed super fund. I don't necessarily buy into that strategically, but clearly what we will identify is if for no other reason than one of the primary reasons that people join into a self-managed super fund with parties other than their spouse is for cost effectiveness. So often has been the case throughout the history of my dealings with self-managed super funds, where you'll see siblings set up or join each other's self-managed superannuation fund. They do that often for one very simple reason: they want to cut their costs. They want to reduce their costs down in the SMSF space, and they think by merging their funds together, they get to achieve that outcome of cost saving. But then they have very different investment philosophies. And so in effect, from an administrative point of view, a number of those funds are almost being administered as 2 or more funds anyhow. And so there's a large amount of additional administration that goes into the process of segregated funds based on investment philosophies. And so you sort of get this ongoing, not necessarily a dilemma, but this ongoing administrative issue associated with lodgement dates, with pension versus accumulation, tax refund versus tax payable on contribution, and all these other areas that are aligned with having different generation or different philosophies based on the membership of funds. So when we're talking about segregation, it can provide that peace of mind for individuals, but it's going to create potentially problems for other parties associated with the fund. And of course, the other reason that we segregate is for the area that I want to lead into and talk about primarily through the presentation, which is enable the fund to identify its exempt income from a taxation purpose point of view. So they would be, for me, the key areas that people look at. And then, of course, what we have to do is say, okay, well, if we're going to segregate, then we need to identify where there are specific rules, tax integrity rules associated with the various transactions, and what that'll mean for the various funds that we're administering, advising on, or indeed being trustee of if it's our own self-managed superannuation fund. So the first thing that I would identify is when we've got pension and accumulation considerations within the same fund, what we need to be mindful of, I was going to use the word respectful of, but it's just being mindful of, is that the fund, the SMSF, is a single tax entity. And I think this is often one of the areas that when I'm presenting to trustees particularly, is getting that message across first, that if we're talking about asset segregation, and we use the term, and everybody would experience this with their clients, is we often use the term, they're my assets, right? Well, from an investment strategy point of view and a member choice point of view, we have the capacity to allocate assets to a specific member of the fund. We have the capacity to allocate assets to a specific pool, whether it's funding pensions or accumulation benefits. But those assets don't obviously belong to the member as such. They belong to the fund, or the fund is holding those assets as part of its broader investment strategy to achieve its sole purpose test requirements, which is to provide retirement benefits for the member or for their beneficiaries. And so ultimately, we've still got to operate under this rule, which is that we're dealing with a single tax entity. And so when we're dealing with a single tax entity, particularly in the space of with the introduction of the transfer balance cap, it adds additional complexities associated with how the income tax of the fund is calculated, the exempt current pension income, all those sorts of other things. Now, whilst it's not a focus of today's presentation, I do touch on it in a moment with regards to how segregation works a little bit. But one of the areas that to me is a little bit of I don't want to say it's a ticking time bomb, because I think maybe some of us, including myself, are making a little bit more of it than necessary. But I also think it's worth making a little bit more of non-arm's length income, because of where the ATO have taken a direction around non-arm's length expenditure. And I think that means that there is a greater capacity, if trustees are not doing the right thing, for income that would otherwise previously have been considered to be exempt pension income to fall under the category of non-arm's length income. And again, if we're starting to pay expenses or not pay expenses of the fund, which historically has been, I wouldn't say necessarily okay, but has historically been sort of overlooked because the definition of non-arm's length income was quite specific. Now that we have greater emphasis on non-arm's length expenses under the Income Tax Act, then there is always the risk that what was previously just standard income for the fund will be non-arm's length income. So I guess it's my big caveat to this entire presentation is that segregation from a tax point of view can be extremely beneficial, but poor behavioural actions via the trustee, based on fund expenses and things like that, on what would be otherwise innocuous expenses, would be problematic for the fund. And I think it's an area that we probably need to make sure is maintained at the forefront of particularly trustees' mind in this space. So self-managed super funds is a single tax entity. That was a lot for that one sentence. Internal asset movements are not a CGT event. So when we're trying to identify when we're looking at taxing events and when tax is applicable, then the movement of assets from pension to accumulation and from segregated to unsegregated pools is not necessarily a taxation event. Sure, we've had triggers like CGT relief as part of super reform, where we effectively triggered a CGT event based on moving from pension to accumulation with the transfer balance cap introduction, and we triggered that CGT event at that point in time to potentially defer it to later. But they're sort of one-off type arrangements versus the concept of when we move from one stream to another, it is a taxing event. The reason I raise it is because it's, again, always been in the background that there's been previously legislation introduced and then removed last minute that was saying that that would be a CGT event. But we need to understand that the movement from accumulation to pension or the other way around in itself is not a CGT event. Franking credits, other tax credits are not apportioned. So again, when we're talking about fund structure, when we're talking about having accumulation members and pension members in the same fund, and I think this is a key issue about segregation. And this to me is almost the singular most complex matter that arises when you've got that pension member wanting and waiting on their franking credits, and you've got that accumulation member who has contributions and pays tax on that contribution. Then those franking credits is going to offset the tax on those contributions, because it comes back to that first point of being a single tax entity. And so what that then creates is this dilemma of, okay, do we need to start moving money around and crediting and debiting member accounts to accommodate those taxation issues? And that's always the problem, particularly of generational self-managed superannuation funds, where you've got the pensioner and the accumulator, and they're not spouses as such, and so therefore they're slightly indifferent towards giving other family members potentially what they consider their tax credit. So those sorts of things are key issues to be mindful of. So again, a lot of these other issues that I've got there, the income and the gains proportionately taxable and stuff like that, are really all part of the broader discussion around how segregation works. And I've highlighted the point about how many bank accounts do we need, because it's a key issue that I want to touch on in a moment. So we will go through the use of segregated versus the non-segregated method, because from a tax consideration point of view, we can and we do have the choice in many instances to choose between using the segregated approach and the proportionate approach. But in other circumstances, we are forced to use another approach, which is primarily the non-segregated or proportionate approach to asset segregation. It shouldn't actually need stating, but segregation is not a tax avoidance arrangement. And now the ATO have released a number of documents over time, and I'll touch on a couple of those in a moment, where they have actually really reiterated that point with asset segregation and identifying that if your objective is to start a pension, segregate an asset, to sell that asset to offset the tax on it, then in many respects, timing is everything. And they will look at some of those transactions to determine whether or not that transaction was entered into for a pure tax avoidance point of view. So just because we think we're in a super fund that there's protection from tax avoidance issues, we need to think again and make sure that we're identifying asset segregation for the purposes of funding the income to provide retirement benefits, not necessarily just to avoid paying capital gains tax on the sale of an asset. Also on that point, I would highlight that segregation doesn't actually require physical separation. And so this is one of those areas where it helps, there's no denying that it helps to have separate investment portfolios from an administrative point of view, but it's not an actual requirement that the fund goes out and creates those separate accounts. But then from an administrative point of view, you want to make sure that you're documenting these sorts of things prior to the point that you move into segregation, so that it's clear, whether it be from an audit point of view, from a tax point of view, which assets are actually segregated. So we'll go through the methods and the other processes as we go through the presentation. As I said before, certain income is not exempt income, so whether we're segregating or not, assessable contributions will always be taxable, and our non-arm's length income. Can't reiterate enough that point about non-arm's length income and the associated expenses, because this income will never be exempt income, and so you could go through an entire process at significant cost to segregate assets to then not meet fund expenses and have the whole lot treated as a non-arm's length income transaction, forever tarnishing those assets. So certainly be mindful of that space. So segregated, or our segregation pros for myself, is that it does give us the opportunity to identify and segregate 100% of assets with large accumulated gains. So again, it's one of those issues where in one breath I'm saying don't do it for tax avoidance, and the next one I'm saying you can, but it really ultimately comes down to the timing, and that is that when you're setting up a pension, your objective from an investment strategy point of view, your investment from in the future, a retirement income strategy point of view, is to be able to fund the pension payments to the individual. So by having large, lumpy assets that have huge gains associated with them but lack liquidity doesn't necessarily make sense in the pure pension environment. However, if you've got those gains to enhance the capital growth point of the fund with a future objective to sell down those assets when liquidity starts to dry up, if that forms part of the fund's investment strategy, then by all means you can address and utilise segregation with reference to large gains associated to the fund. Similarly, high income producing assets. Now, a lot of these measures have their roots directed in the old reasonable benefit limit days before 2007. And it's kind of ironic to me, whether that's the right phrase or not, that we're now in a transfer balance cap environment, so pseudo reasonable benefit limits, where the whole integrity measures around asset segregations was introduced to ensure that people didn't put in, for those with large balances, didn't put specific high growth assets into the pension environment or the pension exempt environment and have their non-growth assets in the accumulation environment. And it stems back to the reasonable benefit limit days, where people had rebatable and non-rebatable pensions. And in many respects, what a lot of people did was put their high growth and high income performing assets into the rebatable reasonable benefit limit space, which gave them much better tax outcomes. Of course, the individual tax outcomes are taken away a little bit now because we're not paying tax post age 60, but now it's more about the fund tax. But to take that one step further, when we're talking about estate planning and the separation of retirement income streams, so we might have one pension that is highly tax-free or high in the tax-free percentage and lower in the taxable percentage, then we may want to segregate certain high growth assets into the proportionately larger tax-free pension, because from an estate planning point of view, even if the fund doesn't get the full benefit of the exempt current pension income deduction due to primarily the disregard of small fund asset rules, then at least that interest will get the growth proportion. And so knowing that all growth is distributable based on the tax-free and taxable percentages when a fund starts, gives that greater estate planning opportunity to distribute benefits in a more tax-friendly environment. So the taxation issue associated with segregation now is more akin to estate planning than it is necessarily to the individual fund member, which is primarily what it was benefiting back before 2007. And so, a bit of a sea change in the way the legislation operates, and based on where the taxing point would dictate why segregation might be beneficial. So there are certainly some good pros for dealing with segregation. And this capital losses point that I've highlighted there, it kind of sits in the pros and the cons area, because if you have capital losses that are attributable to the fund before you move into a 100% segregated environment, then those capital losses will carry through that entire period of when the fund is in a segregated environment, which means that if other members join the fund at a later point in time, you'll have those capital losses available to you. Again, something that needs to be tracked administratively. On the negative side of things is that any capital losses that are received whilst the fund is segregated, whilst the assets are segregated, are effectively ignored. So, you know, the pro of it being that capital gains are ignored when segregated. The con is that capital losses are also ignored, and so you don't have that capacity to carry them forward. And I think one of the key issues about that is that when we're identifying, particularly in a high growth environment, when we're identifying that funds have got capital losses or have the capacity to have capital losses, it's one of those strategies that we should always be mindful of, that capital losses have a significant part to play if there is ever an accumulation benefit within the fund. And so when we're talking about segregated versus non-segregated in a tax point of view, you know, is there a benefit of always maintaining a small accumulation interest to be able to realise those capital losses and carry them forward? The offset being, where does that sit with capital gains and the potential to pay a slight amount of tax? So again, all these things need to be weighed up throughout the process. As I pointed out before, segregation is a proactive tax responsibility. So we need to be thinking about these things before they actually occur. And we are required to effectively, in many respects, separately account for all the investments, all the expenses of the fund. So you are, in some ways, operating multiple funds if you've got segregated assets and then non-segregated assets under the operational mechanics of the superannuation environment. So a few things to be mindful of. You only get an apportionment of certain fund expenses, so things to be mindful of. Can't segregate large lumpy assets, so property becomes fairly problematic in the segregation space if the property is valued greater than the member interest, and that comes back to the tax law that says that you can't segregate more than your actual member balance. So you need to be mindful, and you can't effectively say that 25% of the property belongs to this member, because from a unitised point of view, we're talking about one specific asset. Versus property held in, say, a unit trust where there are units distributable to the fund, and you can say if a fund has 100 units, that 50 units belong to the pension account and 50 units belong to the accumulation account. In that regard, like with shares, we can obviously distribute based on the unitisation of the fund. So from a segregation point of view, there is this requirement for us to separately identify the assets from our accumulation and other assets. And that sort of led us to, I guess, what I would consider, and to give you a very brief history of segregation from the ATO's point of view, we had back in 2013 this draft determination, which was under what circumstances an asset of a super fund is considered segregated from a pension point of view. So that ruling came out, or that determination, in 2013, and ultimately it highlighted that the industry's position and understanding of segregation was exceptionally different, and the ATO felt that they couldn't actually deal with it via the release of a tax determination or a ruling. So they withdrew it. They withdrew that ruling and they replaced it with a tax determination which is still relevant today, which is talking about segregation for bank accounts. And so this comes back to my point before about whether or not we need to maintain separate bank accounts when dealing with asset segregation. And that tax determination ultimately says segregated bank accounts are awesome, right? That's the general phrase from the ATO. However, it also says they're not necessary. So what it ultimately suggests is that we have the capacity, inclusive of self-managed superannuation funds, to operate what we would conceive to be sub-accounts from a banking point of view. Now, that adds complexity in that it means that if we've got our cash management account for the fund and we've got $100,000 in that account, then we effectively, from the day we start a pension, we need to identify and separate how much of that 100,000 is attributable to the pension member versus how much is attributable to the accumulation. So you are adding in a separate layer of administration purely for that sub bank account. What it also means then is, particularly if we're dealing in an environment where we've got one bank account and we've got assets where you've got, say, listed securities, and some of those securities are attributable to the pension account and some are attributable to the accumulation account, and the dividend all hits in one transaction, that we need to make sure that those amounts are split accordingly and addressed almost immediately from a fund point of view. Now, my comment there about the income must be transferred as soon as practicable is, if we do operate under multiple bank accounts, then to maintain and keep one account as a segregated account, if money is incorrectly banked into that account, then we need to move it as soon as practicable. Now, under TD 2013 D7, as soon as practicable was 28 days. Under TD 2014-7, it wasn't spelled out as clearly as that. And so we tend to operate on effectively a 28-day basis. But being mindful that if we have these segregated accounts in place, whether we are creating segregation and accounting for it under one bank account or actually running multiple bank accounts, we need to make sure that income and expenses are attributable to the right bank accounts if we are trying to maintain segregation. So whilst that in itself is not an easy concept to contemplate, segregation itself as well, through the introduction of integrity measures, is also complex, and far more complex now in the post-super reform environment. So, you know, we got into a space where these integrity measures were introduced from 1 July 2017, and they apply to self-managed superannuation funds, also small APRA funds, and it basically suggests that certain funds will be unable to segregate post 1 July 17. These funds are considered to have disregarded small fund assets. The key, and this is now to me a real issue moving forward, is that the disregarded small fund asset rules are linked to members having a total superannuation balance at the previous 30 June of $1.6 million. Now, unlike a lot of our other measures that were introduced under super reform, this measure was not linked to the general transfer balance cap. It was linked to $1.6 million. And so when we have indexation of the general transfer balance cap from 1 July this year, the disregarded small fund balance or small fund assets balance is still linked to a total super balance of $1.6 million. So that is going to create a scenario where you're going to have some people who have less than $1.7 million. They'll have the capacity to commence a pension. It might be all they have in a super environment, but because they've got more than 1.6, they're not going to be able to segregate, and that's going to have other ramifications. So there are issues to be mindful of because of these integrity measures. So what does that all mean? How do these issues work? I'll show you some examples, but basically it identifies or requires that at least one interest in the self-managed super fund is in retirement phase. So it means someone's paying primarily an account-based pension. Just before the start of the income year, a person has a total super balance that exceeds $1.6 million. Now, of course, that total super balance is attributable across all superannuation interests that they have, also superannuation funds. That same person is a retirement phase recipient. Again, not necessarily within the self-managed super fund, but they are receiving a retirement phase income stream from somewhere. And at a time during that year, that person has an interest in the self-managed super fund. So if you've got a two-member fund, ultimately what you're addressing here is that somebody in that fund who's in receipt of retirement income has more than $1.6 million. So it might look like any of these three examples, but in the first example where we've got Sam, who's got 500,000 in accumulation and 250 in the self-managed super fund in retirement phase, and Joe with all their money in retirement phase, on face value, we look at that fund and say, okay, well, they've only got $750,000, $600,000. So therefore this fund could conceivably segregate $1.1 million of the fund assets. But because Sam also has money in a retirement phase in a retail fund, total super balance of 1.7 million, meaning that they've got an integrity issue, which means they'll need to get an actuarial certificate, can't segregate. Similar approach, but if in this instance we might have Sam with a defined benefit pension, so a capped defined benefit pension. They're receiving an income stream from that government super fund, and the special value of that is 950,000. All comes into the consideration. Also becomes a total super balance issue. But probably to me the bigger issue, again, if we're looking at a different scenario for Sam and Joe, is that Sam's got no accumulation interest, but has a retirement phase income stream of $1.7 million. Joe has no accumulation of $600,000. And that's all they have. And Sam commenced that pension with an account-based pension of less than 1.6 million, right? So at the time that fund set up, there was no disregarded small fund assets to contemplate. But now, because the total super balance is 1.7 at 30 June, then we have an SMSF integrity issue. And in this instance, the fund will have to adopt the proportionate approach and get an actuarial certificate, albeit that 100% of these fund assets are supporting retirement income. And so it's kind of it's a legislative anomaly, and it's one that as an industry has been argued for some point in time that under no real set of circumstances should this fund need to obtain an actuarial certificate, because 100% of the assets are supporting a pension, and in every other set of circumstances, the ATO deemed this fund to be a segregated fund, and they call it deemed segregation, and not needing an actuarial certificate. So there is a proposal in place. As I said, it was a budget announcement to remove the need for the actuarial certificate in this requirement, and the proposal suggests that will come in from 1 July 2021. Again, we're still awaiting the legislation on that, so we have to take a wait and see approach as to what that means from segregation. But it also means that my concept of taking a practical approach to segregation and taking a proactive and prospective approach to segregation is quite complex in certain circumstances where you don't know whether or not you are deemed to be segregated or not. There is also a further proposal as part of the proposed changes with the actuarial certification requirements that will allow a fund who's got segregated assets choose to apply the proportionate approach and get a single actuarial certificate for the year. Because as it currently stands, if you've got segregated assets and then you have accumulated assets, then you need to get a certificate for the period that you have an accumulation asset. But then if you go back to segregated again, and then you go back to a proportion approach, then you need to get a certificate for each of those periods. And that's problematic versus the old way where the actuary could ultimately just get a certificate that covered the entire year and exclude the period where all of the assets are segregated. So that kind of leads into the issue of the other approach, and it is I guess the alternative to asset segregation, and it's the alternative if you've got disregarded small fund assets, but it's also the alternative if you're looking for ease of administration, and that is that you just pull the fund investments together. The income is then determined actuarially to determine what proportion is tax-free and what is taxable. It gives you the capacity to cater for larger indivisible assets, but it means you can still ignore partial assets and have them segregated for income point of view, and that income being disregarded for taxation point of view, but then take a proportionate approach to the rest of the investment pool. And I think when we then look at the concept in a moment of member choice, that the entirety or the capacity to use the proportionate approach and apply the actuarial methods to the vast majority of the fund and have isolated segregated assets that are potentially funding pensions is clearly a practice that has been around since day dot in this space. And it's an area that people are used to, as long as they understand and document appropriately that those investments are segregated for the purposes of taxation and for pension purposes, then that works okay. When I come back and talk through these examples that were sent through to me, I'm going to touch a little bit on partial segregation and how that is represented or reflected within, say, the fund accounts, but also from a taxation point of view, when you've got that partial segregation split across accumulation and pension phases and how we can actually deal with it, because ultimately there is no absolute way to deal with it. It's going to require some other sort of, I guess, admin practices or accounting processes to be implemented in this space. But the way that the proportionate method works is really relatively simple, is that we take the average value of the current pension liability. So in all these situations, we remove any of the segregated accounts, which is in very, very simple terms, we take the start balance from the year and the balance at the end of the year, we add them together, and that gives us the average value of the pension accounts within the fund. That is a non-actuary telling you how that calculation works. Obviously, from an actuarial point of view, it's done based on daily transactions. So if contributions are going in, if benefits are coming out, the timing of those contributions, the timing of those benefits are all relevant with reference to current pension liability. And so, for example, if we're talking about applying the proportionate approach, the average value of the superannuation liability, which is the denominator there, that number there represents the balance of the fund at the start of the year versus the balance of the fund at the end of the year as an average, again, excluding any segregated assets. But again, importantly, it's done on a daily basis. So it's almost the rule of thumb to get a higher actuarial percentage is take your pension payments late, but also make your contributions late in the year. So if you're taking pension payments out later in a financial year, then you've got a far higher average pension liability. Whereas if you make your contributions, similarly, if you make your contributions late in the year, it means you've got a smaller gap between the average value current pension liability and the average value fund liability. So, it's an administrative issue to be mindful of from an actuarial point of view. It's not necessarily best practice, because the later you leave things in the year to make a pension payment, if you then don't make that pension payment, then you can forget the entire calculation anyhow, and the fund will move into an environment where it loses exempt current pension income, because if you're making large pension payments late and miss it, then you're not within effectively the 1/12 get out of jail free card environment, which you get once, which is that you make up that payment and still apply the ETPI. So the proportionate method, you don't want to get too cute with it, but you do obviously want to say, okay, well, there are benefits associated with it. Now, when we're talking about tax integrity measures with regards to all of these issues, what I would say is that it does become a little bit about horses for courses with reference to which produces the best tax outcome. And it's very easy to say that segregated assets will provide the best tax outcome because you're identifying certain assets that have a significant capital gain, and you're then able to ignore that capital gain. But until you actually go through and prepare and do the calculations for each fund set of circumstances, it's not necessarily that segregated will always be the best approach, because you may segregate, but you may have had a significant income event occur prior to that point in time that you actually commence the pension. So that event will be fully taxable, and that will be represented in the fund's tax return. So all of these sorts of things become relevant in regards to the decision to segregate and how we actually go about it. And so, as I said, I wanted to spread all of that information out over the course of the presentation to identify the key issues associated with the tax integrity side of things, versus the member choice, which is less of a I guess descriptive side of things and more of an example scenario. And so I do want to use these situations that have been sent through to me, but touch a little bit more on the member investment choice and what we can actually do. So what I will address is I'll go through my key issues here, and then I will run through the scenario that has been sent through to me, or the scenarios that's been sent through to me, and perhaps touch on my thought processes. And if anyone then wants to comment at any point in time, then certainly feel free to add your comments into the Q&A or to the chat box. So ultimately, we've got our income tax rules, which say we can segregate for taxation point of view, but we can also segregate based on member choice. So the SIS legislation provides the capacity for member direction. All right, so it gives us a capacity from an investment strategy point of view, binding nominations and other things like that for members to make choices. Often these things are set out with subject to the governing rules. So ideally, if you're wanting to do investment choice, you want to make sure that the deed provides for it from an individual point of view, that individual capacity. And then you've got to understand, well, why are we undertaking it? Why are we looking at member investment choice specifically for any given superannuation fund? And then what are the ramifications and the issues associated with those choices? So I just highlighted a couple of scenarios there that would dictate time where it may be appropriate to segregate assets in the superannuation fund environment. So the first one that I've identified there is foreign transfers. Now, foreign transfers, largely when I'm talking about foreign transfers, and I perhaps could have been a little clearer with the presentation material, is I'm talking about UK transfers. So if somebody is transferring money from the UK, then that money is effectively what they call, this is not the technical term, but UK sourced funds. When that money hits the self-managed superannuation fund, and without delving into all the potential excess concessional and non-concessional contributions, without delving into the applicable fund earnings issues, that money is always, now the relevance of always is quite specific here, but it's always UK sourced money, right? Now, the longer it's in the fund, the less relevant that becomes. But the shorter the time frame, depending on what you do with that money, can actually be quite important from a reporting point of view back to the UK. And so if you are in a situation where you want to potentially report the commencement of a flexi pension from the UK, which is a reporting requirement in some instances, depending on when you start accessing your superannuation money, then you can apply a very simple proportionate approach where you want to keep where you merge your Australian superannuation money and your UK money, and you basically say, right, when that money came in, it was 50% UK, 50% Australian. So the day you start a pension, we're just going with a 50%, and this is the approach we're taking. Or you can be more specific and you can keep your UK assets separate, so that when it comes time to reporting the pension drawdown or the commencement of that flexi pension, that you are actually able to report the absolute amount that you're starting with that pension to identify that amount as being transferred across into the UK pension sort of system process. So from a UK point of view, it has that benefits. There are other rules around the UK about an inability to invest in residential property. Now, of course, self-managed super funds can invest in residential property. And so by segregating the UK funds from the Australian funds, it means that you can apply separate investment strategies to the various monies available and ensure that you're satisfying both the UK and the Australian laws at the same time. So you've got sort of this concept of dealing with other taxation requirements from other jurisdictions and why segregation might be a relevant application at that point. We then look at diverse family situations. And this is where, again, I've seen it primarily in the situation where we've had individuals where one brother joins a fund with another brother and they have very different investment philosophies. And so they maintain separate asset pools. Now, that's an administrative nightmare because they don't tend to agree with certain things, but it obviously is achievable and they can keep their assets separate. They can run separate bank accounts. You then have other situations, and I'm going to read from the example that Anthony sent through to me before, and I appreciate it because I think this represents what segregation means to a number of people. So we're dealing with a 4-member fund in this situation. So again, thanks Anthony for sending it through. Mum and dad and two kids. In this situation, they're largely estranged from each other. So a fairly unique set of circumstances that all 4 of them are estranged from each other. But let's not say it doesn't happen because clearly we have this situation in front of us. One member has certain investment philosophies to the other members and has effectively gone through the process of trying to segregate assets themselves, but let's just say to varying degrees of success. Now, what I mean by varying degrees of success is they haven't really documented that, right? So from an asset segregation point of view, it's more of a mindset than an actual asset segregation strategy, and it leads to ultimate problems. And so where we have this situation now is we have account balances for these members, and then you've got investments associated with the fund where one member believes all of those investments belong to him, whereas his account balance, subject to drawdowns and other things, is a lot lower than what those assets represent. Now, this is ultimately an administrative nightmare to take over as the administrator of a fund, because you've got the situation where you've got this ideology of what belongs to you versus what actually does belong to you, and what belongs to you is really representative of your actual member balance. Now, had the assets been segregated up front correctly to the husband in this instance, then the income from those assets could have been attributable to the member, but also then any sort of sell down or benefit payments, it could have been identified at that point in time that the member needed to to ultimately sell down on some of those investments to be able to pay the benefit out. And so the concept that Anthony and I were discussing with regards to this is saying, okay, well, if we can get the parties to agree to it, and clearly it's in their best interest to come to some form of agreement, if you can get the parties to agree, can we say, okay, which of these investments, right, fully understanding that your balance isn't what you think your balance is, and that's not an easy conversation to have with people, but assuming that the fund maintains or holds all of these investments, can we say, okay, pick which ones fit within your current member balance, segregate it, hit a point in time, which might be 1 July or whatever it is, segregate those specific assets, understand that you need some cash in your fund if you're paying benefits out, and you need that liquidity to be able to meet the fund's liabilities. Do that to achieve the fund's objectives. So, you get situations where you may have to accommodate thought processes of the past and move them into actual administration capacity for the future. And so segregation will be messy under those circumstances, but you want to get to a point in clarity, and that point is as soon as practicable, where the fund can move forward with as little distress on all the members as possible. So I found that was a really unique set of circumstances to take on board a fund where all of a sudden you found this historical information that really wasn't relevant to the current day and how you go about rectifying it. And so in that instance, the idea of contemplating partial segregation was an interesting one, which led to why I put the next point on there, which is about relationship breakdowns, because again, in the conversation piece, we talked about a fund where the husband and wife separated, but neither of them wanted to give the other one a particular asset. And so the asset was maintained in the self-managed superannuation fund and was segregated specifically to both members. And then all of the other investments of the fund effectively were in the general pool. And the one of the spouses transferred a portion of their benefit to another super fund, but they maintained an interest within the self-managed fund. Now that's fine, because there's nothing that says you have to leave a fund after separation. But then we've got this issue of pensions and accumulations and one specific asset and how we actually segregate it. And really the point about that is that the systems don't cope with that. So most of the systems in the superannuation environment don't cope with member investment choice. They don't cope with the capacity of segregating for anything other than ECPI purposes. And so when we start to get the situation where you have a specific asset that is segregated over pension and accumulation pools and multiple members, then record keeping becomes hugely significant, so that when the income in that is distributed, it may need some additional calculations to be performed beyond the scope of what's happening in the accounting software, and some transactions put in place to make sure that income is distributable appropriately. And of course, that's going to be accounting for exempt current pension income and other things as well, because from an ECPI point of view, it's almost impossible to classify that asset as a segregated pension asset, because it's not. It's actually a segregated member asset, but it has both pension and accumulation interest linked to it, and so it would form part of the broader proportionate approach to segregation. So the whole idea about applying member investment choice is not an issue, but what is an issue is the back-end administration that people need to take into consideration. And so when we do contemplate investment choice for members, we're really contemplating that there are a lot of things that we need to take into consideration with regards to this space. And so to summarize that, what I would say is that it is a complex area, and it's considered a complex area. Correctly, particularly for ECPI purposes, it can be a relatively straightforward process. It's where we start to get into member investment choice, investment strategy segregation, that complexity is an issue. Full segregation is achieved once all of our members are being paid a pension. Now, that's what the ATO deem as segregated, and you don't need an actuarial certificate. Now, there are certain instances where historically you were able to choose in that set of circumstances to still apply the proportionate approach. And that is one of the measures, one of the proposed measures, where if you don't actually stipulate segregation, where you can still apply the proportionate approach. So we need to see the finalisation or the introduction of this legislation to see what that means for a full pension fund. Again, given that you've got 100% exempt income, for most people, you know, the reality of going proportionate versus segregated is not a significant issue. Bank accounts can be partially segregated, lumpy assets can't. So we need to remember that if we're going to have separate bank accounts, that we can actually, also individual bank account, that we can create sub-accounts, but that's going to lead to further administrative issues associated with it. And that it is a prospective tax strategy. And again, I've had people in the past go to a presentation that I've done, and then afterwards try to implement a segregation strategy. And then when questioned as to why they asked for their tax returns to be amended, they said, well, we're going to segregate because we'll get a better tax outcome in that set of circumstances. It was quite rightly questioned by the fund auditor. And indeed, the end result was that, well, that client basically took their bat and ball and went home because they didn't like being told that you couldn't go back and amend your return to segregate something to take into account an effect or an event that had already occurred, despite your pensions already being in place. So, you know, it's got to be prospective. You've got to make sure that it's prospective in the way that you operate. And that when we're talking about segregation, that's not actually tax related, that it has its own administrative issues associated with it. So to me, they're things that we need to be mindful of. So as I said up front, what I really wanted to introduce or talk to you about today was not necessarily, albeit that I did highlight the key issues from an actuarial point of view, but I wanted to address segregation from an administrative point of view and highlight that there are a lot of issues associated with segregation. There are a lot of pros for segregating, and those pros are often linked to tax outcomes, but not necessarily just exempt pension tax outcomes, but estate planning tax outcomes as well. They're the sorts of things that need to be taken into consideration. But of course, it does have its negative connotations, and a lot of that are more from the administrative end, and therefore from the administrative end, it can actually be more costly to segregate assets in a self-managed superannuation fund. So thanks for joining me today in my sort of quick run through of asset segregations and why a self-managed super fund might segregate assets. We will send through a copy of the presentation. I also recently did a technical bulletin covering off on the matter, so by all means, grab a copy of that from our website. And otherwise, I look forward to catching up with you at the end of the month the end of next month, when I talk in regards to currency and currency style investments. So again, dealing a little bit on that whole investment strategy, segregation and fund investments. I'm going to talk on cryptocurrencies, standard currencies, collectible currencies, and what that all means in the SMSF space. So thank you for joining me today, and I look forward to catching up with you all.